I want to talk about some economic data that just came out a few moments ago, and that's the April ISM, the Institute for Supply Management Services Index, the Purchasing Managers Index. It actually came in below estimate, 62.7. The estimate was for a read of 64.1 in April, and it's also a decline month over month. The prior month was 63.7. What does that mean? Well, it might mean that this big services recovery that we're looking for didn't quite, at least it didn't recover to the extent that people were looking for, and actually was down month over month. Really interesting reading there. Let's talk more about the economy, both that number and the labor market more broadly. Joe Song is with us now. He's Bank of America's U.S. economist. Our Brian Chung is with us as well. Joe, if I can throw to you on that services read, first of all, I just think that's a really interesting read here, given this thesis and the hopes that have been pinned on services coming roaring back. That number, it's not a weak number, but it's not a roar either, or is it?
Look, 62.7 is still a pretty strong number. It's still suggesting that the service side of the economy is ramping up. Now, it's not ramping up as quickly as maybe we had previously anticipated. And that might speak to some of the kind of bottlenecks and frictions that remain in the service sector. Now, not all areas of the country is reopen to 100%, but we know that that's going to be coming down the pipe. Just here in New York City, we have announcements that New York City is going to reopen to 100% over the next few weeks, and other cities and state and local municipalities will follow. So, that's going to lead to a better surge in services demand. But there are going to be frictions and shortages that come along with that reopening process.
Hey, Joe, Brian Chung here. Great to speak with you again. I want to ask about a report that your team over at Bank of America Securities had last week, where you kind of extrapolated some Bureau of Labor Statistics data and estimated that about 4.6 million workers are missing from the labor force because of the pandemic. Now, some of those people are gone for good. They've retired, for example. But what is going to be the key to getting the other, let's say, 3 or plus million people back into the labor force? That's a big question the Federal Reserve is asking right now. Is it wages? Is it some other type of measure? What, I guess, is Bank of America seeing in terms of policy that can bring those people back in?
Yeah, there are a slew of factors that we found when we were digging through the folks that left the labor force during the pandemic. A big segment of the workers are still concerned about the pandemic. We estimated roughly about 1.6 million workers want a job but didn't look for a job, recently because they were still concerned about contracting the virus or other factors around the pandemic. On top of that, you had some workers, citing that childcare issue was still, a big factor for their decision not to participate in the labor market. We remember at the turn of the year, there was a lot of work done by the Federal Reserve that showed that women with children were leaving the labor force at a much faster pace than men. So I think that kind of speaks to that concern of taking care of family members and children. The other factor that we found is that the generous unemployment insurance benefits could be keeping back workers on the sidelines as well. The additional $300 a week that unemployment insurance beneficiaries get, that means that on a prorated basis, if you're making less than about $32,000 a year, you're actually better off on unemployment insurance than working. And take all those factors together. You're concerned about the pandemic. Maybe you have childcare issues at home. You're better off being on unemployment insurance. That's going to kind of lean you towards, staying on the sidelines rather than, engaging in the economy for now.
And, Joe, I know we're still coming out of the recession. I suppose we're all waiting for the NBER to call it and say the recession ended at some point. But as you guys kind of look forward, maybe over the next couple of years, how are you trying to tease out whether the economy has indeed been put on a faster long-term growth path than we were on pre-crisis? Is that an idea that you guys are thinking about now? And where do you come down on that issue if you are?
Yeah, that is clearly, a critical question for, how we think about both on the, on the path of recovery and also, how quickly inflationary pressures could build in the economy. I think it's a little too soon to say one way or the other. There are arguments on both sides you can make. What we're seeing right now is that a lot of businesses are doing more with less, right? We're expecting double-digit growth, in the second quarter. Meanwhile, jobs are probably not going to be back to pre-pandemic levels until sometime next year. So, at least early on in the recovery, you will likely see better productivity numbers. Now, will those hold and it be sustained? That's unclear at the moment. I think it really depends on, has the economy structurally changed coming out of the pandemic? And I think it's too early to say one way or the other.
Joe, I want to come back to the unemployment insurance question because I have found this question so intriguing. This assertion, mostly on the part of employers, people aren't coming back because they're getting that money. And we most recently heard this, and this is an example I keep coming back to. Pilgrim's Pride, the chicken processor, said, we're having trouble finding employees because of this. I wonder how many of these folks will just have taken the opportunity also. I mean, it's not just that they're getting more, it's that maybe working in a chicken plant hasn't been the safest through the pandemic, and B, is not that wonderful of a job to have to go to every day, if I might. So, how is this going to fundamentally change some of the dynamics in the jobs market as a result of all of this?
I don't think it'll fundamentally change, the labor market structure per se. Remember that the more generous unemployment insurance benefits actually go away, post Labor Day. So, regular unemployment insurance benefits, you're looking at a wage replacement rate of around 50 to 60%, right? So half of what you were making previously. On top of that, it's not for forever, right? These benefits have a duration of anywhere between 26 to 52 weeks, depending on where you live. So there is definitely going to be an incentive to kind of get you back into the labor market. Now, to your question about the industry breakdown moving forward, as you guys noted in the previous segment, there's a price for everything, right? Where things will clear. So if it turns out there are labor shortages in certain sectors, you're going to see wages bid up in those sectors to meet that demand and get the supply in the right areas. Now, I think that what that means is that you'll see spurts of wage inflation across industries, across geographic regions, but those will generally prove transitory, and ultimately, the fundamentals of wage dynamics will be, we'll go back to, how tight is the overall labor market over the next several quarters.
And Joe, that's a really interesting point that you bring up because, inflation is something that the Fed is watching, but they've kind of made it clear that the closer they can get to maximum employment is the real goal that they're having here with allowing this monetary policy to run hot. But the conclusion of your work appeared to be that labor force participation rate likely won't return to pre-pandemic levels over the next 2 years. So all of that in summary, does that mean that the Fed is going to hold on that easy policy for even longer than expected based off of what you're extrapolating from that labor market data?
Well, it's quite possible. I guess I take a different stance on that in that, if you have fewer workers entering the labor market, that means that, the labor force participation rate could actually fall, won't recover back to pre-pandemic levels, which means that the unemployment rate could actually fall faster than what we're currently anticipating, right? And these are kind of trends, that we've been seeing over the decade, right? This is more about demographic trends, and less so about the pandemic. And I think the Fed is, aware of these trends. So I don't think it necessarily moves them per se, but I think the one concern that you have is that if the unemployment rate falls faster than what we are anticipating or what the Fed is anticipating, that could mean that wage pressures build much sooner than what we're expecting. And that could mean that those wage pressures get transferred over to prices, higher inflation. That's going to put the Fed in a bind, and that might mean that they have to signal earlier than they're currently anticipating for a liftoff.